How to read candlesticks with zero experience in trading. Most traders lose thousands and thousands because of one single thing. They don't understand the right way to read candlestick charts. Here's the thing. Technical analysis is a language, much like music. And like any language, once you understand the vocabulary and grammar, you can read it anywhere. Stocks, crypto, forex, futures, it does not matter. So in the next 10 minutes, I'm going to teach you how to read candlestick patterns like an experienced trader. We're going to cover the fundamental high probability setups I actually use every single day and how to put all this together into a systematic approach that just works. By the end of this video, you'll understand what the market is telling you, where the opportunities are, and how to time your entries. So let's get into it. So first things first, candlesticks. A candlestick tells you a story about what happened during a certain time period. Whether it's a weekly candle, a 5-minute candle, or a daily candle, every single candlestick gives you 4 pieces of information: the open, the high, the low, and the close. Then there's the wicks. The upper wick shows you the highest price that was reached during that period, and the lower wick shows you the lowest price. But what they're really showing you is rejection. If you have a long upper wick, that means price tried to go higher, but sellers smashed it back down. And a lower wick means the opposite. Price tried to go higher, but buyers said, no way, and pushed it back up. Now let's talk about some specific patterns you need to recognize. Maru Bozu. This is when you see a candle with almost no wicks and just a big body. This means that there's one side of the market that is absolutely dominating. Just pure momentum in one direction and strong conviction. The hammer. This shows up at the bottom of a move. Small body, long lower wick. It's literally hammering out the base, rejecting lower prices. That's your signal that sellers are losing control. For example, let's say you're watching Tesla and it's been dropping all morning, and you see a hammer form at 240 with a long lower wick to 237. That wick tells you sellers tried to push it lower but failed. When you see that hammer at a key support level, that's often where the reversal starts. Then we have the shooting star. It's a small body with a long upper wick. It tried to shoot higher, but got rejected. That's telling you buyers are exhausted. The doji. When the open and close are basically the same price, that is pure indecision. The market doesn't know what it wants to do yet. The key here is understanding that these patterns show what's really happening psychologically in the market. Who's in control? Who's panicking? Who's getting trapped? Master this foundation and everything else becomes clear. And hey, if you're finding value in this, hit that subscribe button right now. I drop videos like this regularly that'll keep sharpening your trading edge, and you don't want to miss them. All right. So individual candles do tell a story, but when they cluster together, they create even stronger signals that the inexperienced trader cannot see. Let's talk about patterns, and specifically the ones that can actually make you money. I'm not going to waste your time with 50 different patterns you'll never use or remember. I'm going to show you the 2 setups I look for every single day. First up, the inside candle. An inside candle, also known as a harami, is a 2-candle pattern where the second candle's high and low are completely inside the high and low of the previous candle. It shows a short pause or consolidation, meaning price is temporarily contained after a larger move. Here's how it looks. Candle 1, which is often called the mother bar, has a wider range from high to low. Candle 2 has a lower high and a higher low than candle 1, so it fits entirely inside candle 1's range. Here's what it implies. It usually signals indecision or a pause in the current trend, as buyers and sellers are temporarily balanced. Traders often watch for a break above or below the mother bar's range as a potential signal for the next move. Three crows, usually called three black crows, is a bearish reversal candlestick pattern made of three strong down candles in a row, usually after a move higher or uptrend. Each candle opens somewhat within the prior candle's body and then closes lower than the previous close, showing sellers are taking control step by step. It appears after a rise in price and signals that the prior bullish move is probably ending. It has three consecutive bearish candles with relatively large real bodies and little to no wicks, each closing near its low. Each candle opens below the prior open and then pushes to a new short-term low. Here's how to interpret these candles simply. Bulls were in control, but for three candles in a row, sellers pushed price down strongly, suggesting that momentum has flipped to the downside. Traders often treat it as a warning of a potential trend reversal and may look for extra confirmation, support breaks, volume indicators before acting on it. This can also signal a brief pullback in the trend and doesn't have to be a reversal. The three soldiers pattern, which is also known as three white soldiers, is a bullish reversal made up of three strong up candles in a row after a decline. It looks like three consecutive bullish candles, each with a relatively large real body. Each candle opens inside the prior candle's body and closes higher than the previous close, forming a staircase up. Wicks are usually small, showing buyers stayed in control during each candle. And here's what it suggests. After a downtrend, it signals that selling pressure is fading and buyers are taking over. Traders often read it as early evidence of a potential new uptrend or at least a strong bullish push, especially if supported by volume and key support levels. Again, this could just be a quick retracement or pullback within the overall move. Here's a simple takeaway. Three solid up candles, one after the other, after a drop equal a strong, organized buying environment and a potential shift from bearish to bullish conditions. By the way, some of you may like to trade an FVG or fair value gap. You'll want to learn these two patterns since usually FVGs are three crows or three soldiers. Now, these patterns work because they represent real market psychology, but you just can't trade these patterns blindly because a pattern on its own is really nothing more than perhaps a high probability guess. Time to save you years of trial and error. You just need these two indicators for context: an anchored volume-weighted average price and exponential moving averages. Let's start with the AVWAP, or anchored volume weighted average price. This is the line that institutions care about. It's weighted by volume, which means it shows you the true equilibrium price for the day. Here's how to think about it. If price is above the AVWAP, the market is bullish. If price is below the AVWAP, the market is bearish. Institutions use this as their benchmark. They will buy at or below the anchored volume weighted average price because that's where they're getting value. Let me give you a real example. Say you're trading the SPY, the S&P ETF, in the morning session, and the anchored volume weighted average price is sitting at 280. Price dips down to 279.50 and it touches the anchored VWAP and immediately bounces back to 282. That dip to and even slightly through the AVWAP was the entry signal. Institutions were buying at fair value, and you want to be right there with them. So when you see price trading above the anchored VWAP, you're very likely trading with the big money. When you're below it, you're fighting uphill. Now, there are three key plays with an anchored volume weighted average price. First, a dip to the AVWAP. Price is above the VWAP, it pulls back, it tags it, and bounces. That's your long off support. Second, fade off the anchored volume weighted average price. Price comes up from below, hits the AVWAP as resistance, and gets rejected. That's your short off that level. Third, a break and retest. Price breaks the anchored volume weighted average price, comes back to test it, and holds. After that, it continues. That's the clean continuation. Now let's move to the second main element to understand context: exponential moving averages. I use 3 EMAs on any time frame. So let's use the daily: the 21, the 34, and the 200. The 21 EMA is my first aggressive support in an uptrend. If price respects it on a pullback, that could be an entry. If the 21 fails, the 34 EMA on the low is my backup level, and usually I'll put my stop just below it. The 200 EMA shows the larger trend or larger bullish or bearish sentiment. Above it, you have what I will call the bullish hemisphere. Below it, you're fighting in the bearish hemisphere. So think of them as steps. Price climbs to 21 and then the 34, all above the 200 in the bullish hemisphere. A little side note on volume. If you see high volume on the green candles pushing up, that is participation. That is real strength. On the contrary, if you see light volume on the pullback candles, that could be a healthy pullback before volume comes back and takes price in the original direction. There was low participation in the counter trend move. The volume profile tells you the real story of the levels. As you can see, this is not rocket science. It's about reading what the market is actually showing you and trading in alignment with where the real money via volume is positioned. Cool. So these are indicators that are proven to work, but only if you're trading at the right levels. Picking the right time frame is a must if you want to achieve profitability and consistent results in trading. And here's how I do it. To this day, I start with the daily chart. That's actually my preferred chart for swing or overnight trading. I'm looking at where the 200 EMA is, where are the major support and resistance levels, and where even gaps might be. Then I'll take a look at the 21 EMA. That's where I'm looking for some clarity on the trend or even just persistence in the follow through. And it's also initial support. After that, I'll zoom in on the 34 EMA for a mean reversion in a trend. This is where I'm watching for that exact zone to pull the trigger in a pullback. All three levels need to work with one another. If the daily chart is showing resistance overhead and I'm trying to go long on an inside candle, I might be asking for trouble. That's fighting the market sentiment. That's getting long right in front of a ceiling. Here's how it looked on a recent trade. On the daily chart, Apple had space above the 200 EMA with no resistance until 235. I saw a perfect inside candle forming at 230. I waited for the breakout candle above the inside candle. All the levels aligned bullish. That's when I entered. And it then ran into my target. All right, now you've got the tools. So let me show you the process I use to find and execute trades daily. First is finding the right vehicle or stock. Maybe it's an ETF. You need a relative outperforming stock or ETF. And what I'm talking about is a stock or a sector that's moving significantly better than its peers. This could be a strong stock in a sector. This could be a strong stock in an index. And preferably it's above the anchored volume weighted average price. That's where the attention is. That's where the opportunities and the follow through are. You'll probably also want a catalyst-driven move. So that means whether it's data or a price breakout or higher volume, something's creating that action because it's got attention. Now, once you've got your watch list, here's your pre-market homework. Pull up the daily chart first. Check where the price is relative to the 21, 34, and 200 exponential moving average. Identify your levels. Draw your major support and resistance levels. Make sure there's actually room for the stock to move off support before it hits a brick wall of resistance. Then, and only then, do you look at the setup to evaluate the entry, stop, and target. Here's my execution checklist that I follow religiously. First, price ideally needs to be above the anchored volume weighted average price. The volume profile has to be confirmed. High volume on green candles pushing higher. Light volume on red pullback candles. You want the participation in the direction of your trade to be high, while participation against the trend to be low. Confluence. The alignment of the levels. The daily supports the move. The support or the pattern shows the setups, and the resistance will give me a precise target. I'm entering near the 21 EMA with a stop below my support. It could be the 34 EMA as well. This keeps my risk tight and defined. Let me walk you through how this looked yesterday. I scanned and found a tech stock that was up considerably with a 2x normal volume. That's attention. The daily showed room to run, and the inside candle forming with price respecting the 34 EMA. Price was above the anchored volume weighted average price. Volume confirmed, heavy on the green candle. In other words, there was a lot of participation. I entered at 32.60 and set the stop at 32.30, below the 34 EMA. It ran to 36.80, and that is the checklist in action. All the levels determined beforehand. What we covered today gives you that framework, but mastering it takes practice and real feedback tailored to your own ego and fear traps. Check the description for resources that'll help you reinforce these concepts. And if you're ready to start seeing real results, my live trading room is built specifically for traders who want accountability, personalized feedback, clear path forward. Imagine waking up each day knowing that you have a supportive community. You can see exactly what I'm looking for on the charts, executing with confidence, and having the power to consistently grow an account. That's the transformation I help my students achieve, and it could be your reality too.